Nobody comes out of the womb producing millions of dollars worth of value. Debt is just a way for you to take your future income and spend it right now. If you have to work every single day in order to fund your lifestyle, you are not wealthy. You have no freedom. What's up, everybody? I am Jasprit Singh from theminorityMindset.com, where money minds rethink rich. Everybody's goal financially is to be financially free, but the steps that you need to take in order to have that financial freedom aren't always so clear. That's why in this video, I put together some of our best clips that will walk you through what you need to know to be financially free. Let's go. If you're in a place where you're earning money but you feel financially stuck because you just don't know what to do with your money to get to the next level, you are not alone. The inspiration for this video came from a conversation I had with my friend just a week ago because we were talking about money, and he was telling me about how when he got his first job, which wasn't that long ago, he really had no clue where to start with his money, and he came onto our channel and he was still kind of overwhelmed because he didn't know where to start. So I figured, okay, this would be a good opportunity for me to go out there and really just put out a video that will lay out the foundation of how to use your money from A to Z. This video is going to be a little bit different than my other videos because I don't have a script. I just have the 10 different things that I'm going to be talking about, and everything else is just me. So I'm about to grab my whiteboard, that way I can draw it all out. But before we get into that, I need you to do me a quick favor and smash that thumbs up button below, because the way the YouTube algorithm works, if you do not smash that thumbs up button, then YouTube is much less likely to show you and other people our financial news and education videos. The very first thing you gotta do before you worry about investing your money or budgeting your money or doing anything is you gotta calculate and figure out how much money is coming in and how much money is going out. If you do not know how much money you have coming in and out, you are just gonna be one big question mark when it comes to money. So I want you to pull out a piece of paper, pull out your pay stubs, pull out your credit card statements and your bank statements, look at how much money you have coming in every single month, and then look at how much money is going out. This is gonna give you a good idea of just kind of a broad picture overview of where your finances are right now. The reason this is so important to start with is because the majority of people in America are living a life where they have $1 coming in, and for every dollar that comes in, they have $1.20 going out because they're financing their life with credit cards and lines of credit and debt. The crazy thing is that there's a lot of people that don't actually realize that they're living like this because they're just making the minimum payments on all their cards and their debt payments, and so they're making money and they're making the payments thinking that everything is okay because they never actually take a look at their finances. So what I want you to do is literally just take a piece of paper and draw 3 columns on it. Draw one with how much money is coming in, so your income. Draw one with how much money is going out, so this is your expenses. And then draw one with where else this money is going. So are you investing? Are you saving? Where else is your money going? Maybe it's charity. You gotta know exactly where this money is going. Once you got that piece of paper that shows where all of your money is going, keep it, because you're going to be looking at that every single month, because I want you to do this financial analysis of your money every month. That way you can see how you're improving on your finances. I used to guest teach in Detroit public schools. I love teaching, and I used to go to these schools to talk to the kids about entrepreneurship and just general money management. And one time I asked the class, how many of you kids are working a job right now? And almost every kid in the class raised their hand. And then the next question I asked them was, how many of you have a bank account? And out of all these kids that had their hands up, there was like 2 or 3 that maybe kept their hands up. They had all these kids that were going to work, getting a paycheck, but they didn't have a bank account. So what they did was they would get this physical check from their job, and then they would go to the liquor store, pay the liquor store owner 10% of their check to get their cash. So if you made $100, your liquor store owner is going to take $10, so you got $90 left. And then on the way out, you're going to buy chips, you're going to buy pop, you're going to buy a bunch of other dumb things, and then by the time you're out, half your paycheck is going to be gone. Banks are in the business of making loans, okay? The way they make money is by keeping you in debt. You need to understand that. This doesn't always mean that you should just avoid banks or never use them. That means you need to know how banks work. That way you can use banks to your advantage. You need to have at least 2 different bank accounts. You want to have a checking account and you want to have a savings account. They have 2 different purposes because they have 2 different uses. These two are the bare minimum. Once you get more involved on the investing side of things, you might open up a third bank account to hold your cash for your investments, but let's just focus on these two for now. So your checking account is the money that you're going to be using for spending. So if you have a credit card or a debit card, this card is going to be linked to your checking account because checking accounts let you do a lot more transactions in that bank account. So this checking account is the cash that you have to spend every single month. Your groceries, your rent, your shopping, all of that goes out of this account right here. Your savings account is your savings money. This is not the money that you use to go buy groceries from. The savings account is the money that you're either going to be saving for a big purchase or for your emergency fund. You should actually have two different savings accounts if you're going to have this emergency fund and you're saving for a big purchase like a down payment on a house, because you don't want to commingle the two. You need to have an emergency savings account. This is the money that you use for emergencies only. So if you lose your job or if a tragedy happens, this is the money you have for that. This should be its own savings account, and if you're saving for something like a house or if you're saving for something big, that should have its own separate savings account. Checking accounts and savings accounts have different rules at banks. Like I was kind of mentioning earlier, you can do a lot more transactions in and out of a checking account than you can do with a savings account. So with the savings account, a bank might say you could only do 6 transactions a month, and if you do more than 6 transactions a month, just for an example, then they're going to charge you a fee. Savings accounts also sometimes pay you a higher interest on your money because the bank knows that the money isn't going to be leaving your savings account as much as it will your checking account. The tricky thing with that in the environment that we're in right now in this economy is that we are in a very low interest rate environment. So what that means is if you go out and take a loan, your loan is going to be a very low interest rate, which is good news if you're borrowing money for something good. But the downfall is your bank is going to pay you a very low interest rate on your savings. There used to be a time when banks would pay 2, 3, 4, 5% interest on your savings. Now, you'd be lucky if you get 1% interest on your savings. One thing that you can do here with your savings, and one thing that I do with my savings, is because I don't use my savings every day like I do my checkings account, you can move your savings money into a high interest online savings account because these online banks have lower overhead fees because they don't have all these like retail branches everywhere. They don't have to pay for tellers and all of that. So they don't have all these retail fees, so they can pay you a higher interest on your savings. Now, it's not anything crazy. It's not going to make up for an investment or anything like that, but it's better than what you're getting at most traditional banks. By the way, I'm going to be talking about a ton of different topics throughout this video, and if there's something that you want to learn more about, like high interest savings accounts, I'll put more resources for you in the description below. Okay, so you want to have a minimum of 2 different bank accounts, your checkings account and your savings account, and what you want to do is when you get your money direct deposited into your bank account from your job, what you should do is create an automatic transfer that moves money from your checking account to your savings account automatically. That way every single month you have money being saved without you having to touch it. That way you know, okay, I don't have extra money to spend because this money has already left your account and it's already been saved. That way you can't accidentally spend this savings money on a brand new TV. Many banks offer features like this for free, so make sure you ask your bank, and you also want to make sure that your bank is not charging you a monthly maintenance fee. So my grandma, who doesn't really speak English, had a bank account with Bank of America for 15 years. And one day, this is actually not that long ago, I went to kind of look at her financial bank statements with her, and I found out that Bank of America was charging her, I think it was $15 a month as a monthly maintenance fee for doing nothing, essentially. So for the last, I don't know how many years, they were charging her $15 a month for no reason, and she kept paying it because she doesn't know that there was alternatives out there. You do not need to pay a monthly maintenance fee just to use the bank account, okay? We are in a new digital age where these type of fees are just, you don't need to do that, okay? So make sure you do your research on your bank. Look for the different bank accounts that you can have. Create a way that when you get paid, you automatically have money moving to your savings account. And if you have a separate bank account for your investment cash, do the same thing for that. That way your money is automatically going to the places where it needs to be. And do not pay any fees that you do not need to pay. Third, let's talk about debt, because not all debt is the same. If you have any sort of high interest debt, so these are things like credit cards or hard money loans, if you have this type of high interest debt, then your sole focus in the beginning right now should be to pay off this high interest debt. All your friends are probably talking about how much money they're making by investing in Tesla or this other hot stock. This should not be your focus right now. Right now, the only thing that you should be doing with your extra money is paying down this debt, because when you have this type of high interest debt where you're paying 10, 12, 15% a year in interest, then your money is compounding and building wealth, not for you, but for your credit card company. You need to pay this off as fast as possible and use every extra penny that you can to pay off this high interest debt. Do not worry about investing. Do not worry about doing anything else until you pay off this high interest debt. I mean, to be honest, you should not be going on vacation. You should not have a Netflix subscription. You should not be eating at restaurants if you have credit card debt. If you have this type of high interest credit card debt, you need to be laser focused to pay down this high interest debt first. So when it comes to debt, you want to get rid of it as fast as possible, and you want to stop fueling the thing that got you into this debt in the first place. If you cannot control your spending, get rid of your credit card until you can control your spending and until you can pay down this debt. The secret to building wealth is not by pinching pennies. It's by using your money strategically to buy things, assets, which are things that are going to make you more money. This is what investing is all about, and anybody who wants to build wealth has to invest their money. But just like how all debt isn't the same, all investing isn't the same. The first thing you want to do when it comes to investing is put aside some cash that you can use towards your wealth building fund. This is the money that you're going to use to make yourself wealthy by investing this money. The second thing you have to do is you got to ask yourself what your risk tolerance is. If you have any sort of low interest debt, so these are things like a car payment or a mortgage or student loans, one of the things that you can do to invest your money and get a guaranteed return is pay off your debt early. Because let's say you have student loans that's charging you 6% a year and you pay off your student loans 2 years early. That's 6% you're going to get on your money guaranteed during this 2 years, because that's 6% interest that you do not have to pay to the bank. This is the least risky way to invest your money because you're getting a guaranteed return on your money. If you don't have any sort of low interest debt or you want to take on a little bit more risk, then you can put your money into the market. Now, when I say put your money into the market, everybody assumes I mean that you need to go and start picking stocks. But the majority of people shouldn't actually be in the stock picking game. There are other ways that you can invest your money into the market without actually picking stocks, by investing in something called an ETF. An ETF is essentially a fund that gives you exposure to multiple different stocks. So now, instead of you going out and trying to find the best stock to invest in, you can invest in an ETF or a fund that's going to give you exposure to the entire stock market. Now, if the stock market goes up, your fund goes up. If the stock market goes down, your fund goes down. Or if you want to be a little bit more specific or technical, you can invest in an ETF that gives you exposure to the tech stocks, or an ETF that gives you exposure to healthcare stocks. So this is a way for you to now invest your money and get the returns that you get in the stock market without actually having to pick stocks. If you want to be more involved with your investments, then you can look at investing in something like individual stocks or real estate. Now, like I was saying before, the further you come down this, the more risk there is. Like paying down debt has the least risk, investing in an ETF has a little bit more risk, and investing in individual stocks or real estate has even more risk than that. But more risk comes with more potential. Not always more return, but more potential return, because you can invest in a company right before it goes big, or you can invest in real estate in a location where there's a lot of demand coming and there's a lot of developments coming, so the value of your real estate goes up and your rental values go up. Again, this is now going to depend on what your financial goals are, and you have to be honest with yourself. What kind of life do you want to live financially? If you really want to live large and do these lavish things, and all you're doing is just paying down debt with all of your extra cash, you are going to have a tough time getting there, because you're going to need to earn more money. Yeah, you also have the potential to lose more money because you're taking on more risk, but if you don't take that risk, then you don't have the opportunity to get towards your goals. You should also understand the different ways that you can make money through your investments. So when people invest in the stock market, most of the time their goal is to buy a stock today for, let's say, $100, and then 5 years from now or 10 years from now, sell that stock for $200 or $300 or whatever. So you're buying an investment today at a certain price, and you want to sell it at a much higher price in the future. With real estate, it's very different. You're buying real estate not to just flip it for a higher price. You're buying real estate now to get rental income. So you're creating passive income with real estate, because you can go out and buy a house or buy an apartment complex or something, and now you're going to have tenants living there, and these tenants are going to pay you rent every single month. So if you buy a property and you lease it out for $1,200 a month, you might make $700 a month in profit from that property every single month, as long as you have a tenant living there. So this can help create you passive income. You can do the same thing with stocks through dividends. dividends, but a lot of times when people invest in stocks, they're looking for that appreciation. So they want to see that price growth. So you got to know what kind of goals you have when you are investing your money. We're about to switch gears to number 5. But if you do want to learn more about this investing and money management, we do have a free ebook on money management and investing that you can read for free when you sign up for our financial education emails, which are also free. You can get a free ebook and start reading our financial education emails by clicking the link up here or by clicking the link in the description below. Now, number 5, spending. When it comes to spending, the first thing you have to understand is the difference between an asset and a liability. An asset is something that puts money into your pocket. A liability is something that takes money away from your pocket. So now, when you're spending money, you gotta know what you're buying and you gotta know where your money is going. Is your spending taking all of your money away from your pocket, or is your spending bringing money back into your pocket? Most of the things that we buy are liabilities. So your clothes, your shoes, your cars, everything that you're wearing and showing, these are all liabilities. Because when you spend $100 on a new shirt or you spend $40,000 on a brand new car, that money is gone. And if you try to sell that thing, you're not gonna get your money back. Like even if you go out and you buy a brand new car today for $40,000 and you drive it around for a couple of years, when you go to sell it, you're not gonna get anywhere near the $40,000. And if you bought a brand new shirt for $100 today and you try to sell it, you're not gonna get $100 for that shirt. So liabilities are things that take money away. Assets are things that put money back into your pocket. These are what we just talked about, investments. So stock market investments, real estate investments, these are things that you buy for the purpose of making money and building wealth. If you really want to become wealthy, you got to be buying more assets than liabilities. The only way that you can do that is by spending less money on liabilities. That way you have more money to spend on assets. Right now, the majority of people are living paycheck to paycheck because all their money is going to liabilities and then they have no money left over to buy assets. So what I want you to understand when it comes to spending now is if you are buying a liability. So if you're buying a car, you're buying anything that's not putting money back into your pocket, you are no longer allowed to finance it. Period. Okay? The only thing that you can consider financing here is your own home, but your car, your clothes, everything else like that, no more financing it. No more store credit cards because you don't have the money to buy it. No more paying 0% APR for something because you don't have the money to buy it. Now, I know what you're thinking. 0% APR, what's the big deal about that? You're not paying any interest. Yeah, but there's a reason why 0% APR is so profitable for businesses and banks. 0% APR works because they know that if you go into a monthly payment plan on something that's $1,000, so you're buying this brand new phone for $1,000 and you're gonna pay it off 0% APR for the next 1 or 2 years, well, what's gonna happen? That means you don't have $1,000 to buy the phone today, so you are going into debt to buy the phone, and the majority of people are not gonna pay it off in time, so now you're gonna get slapped with a big fine at the end of your 0% APR period because you didn't pay it off in time. And you also think that you have more money to spend right now because you didn't have the pain of $1,000 leaving your wallet today. So yeah, you might not be paying any interest on that money today, but you're also not feeling that pain of the money leaving your account, so you're more likely to go out and spend more money on liabilities that you shouldn't. Don't play that game. If it doesn't put money back into your pocket, buy it with cash and don't worry about it. And the way that you know what you can afford when it comes to liabilities is by following our rule of 5. If you cannot buy 5 of them, you cannot afford 1 of them. If you follow that rule when it comes to liabilities for things that you do not need to survive, you will have more cash to buy more assets, which are going to put more money back into your pocket. Going along with spending, let's talk about credit cards. Depending on who you are and depending on your spending habits, credit cards can be your biggest enemy or your biggest ally. I love credit cards. I try to only make my purchases on credit cards because I get cash back, I get free perks, I get free rewards, and I get free purchase protection. So when I buy things, I buy it with my credit card because I get all these rewards, and I know that I'm always gonna pay my entire credit card balance in full every single month. That way I never have to pay a penny in interest. If you wanna use your credit card the right way, you need to first understand how your credit card company makes money. That way you can understand this, and that way you can use your credit card in a way that's going to benefit you. So every time you swipe your credit card is going to charge the store a fee for processing the payment. So if you go to Walmart and you check out with your Visa, now Visa is going to charge Walmart a fee for processing this transaction and for processing this money. So every time you swipe your card, the store owner is going to get charged a fee. They might charge your store 3%, which is why the credit card company can pay you 1-2% cash back. The second way your credit card company makes money is through APR. So if you don't pay off your credit card and you got to pay your credit card company interest, then your credit card is going to make a windfall because they're going to get a crazy interest rate on money that you are not financing from your credit card. You never, ever want to get into the game of paying this APR for credit cards, okay? This is always a losing transaction. So if you're using a credit card, you need to treat it like a debit card. That way you're only buying things that you normally would with cash and then pay off your entire credit card balance in full every month. That way you never have to pay a penny in interest. Now, if you're not going to get charged an extra fee to use your credit card, you might as well use your credit card because your credit card is going to charge the store a fee and then they give you a kickback for doing that. That's what your rewards are. So if you go to Walmart and you buy $100 worth of groceries and you swipe with your Visa, Visa might charge Walmart $3 to process this transaction, and if you use a Visa, they might pay you back $1.50 in cash back just for using their credit card. If you didn't use your credit card, you'd have to pay Walmart $100 in cash and you wouldn't get any cash back. But because you used your Visa, you got $1.50 back. But this only works if you understand how to use a credit card the right way and if you can control your spending. If you cannot control your spending and you don't think that this is going to work for you because you are going to overspend or you're not going to pay off your credit card, then don't use your credit cards. The rewards are not worth it. But if you know that you're never going to pay a penny in interest because you're only going to buy what you can afford and you will always pay off your entire balance in full every single month, then get a credit card. That way you can get your rewards. Once you get to this point, now you are really on your path to wealth, and now is when you want to start thinking about how you're going to protect your wealth and pass on your wealth. This is what estate planning is all about. Now, I am an attorney, which is why I want to talk about this, but I am not your attorney. So if you do have specific legal questions, talk to a professional in your area. So the first thing when it comes to estate planning is you got to think about, okay, when I die, because I know eventually everybody will die. It sucks to think about, but it's reality. When you die, what do you want to happen to your assets and your money? Who do you want to get it? So this is what a will is all about. A will essentially tells the world, okay, when I pass, this is what I want to happen with all of my money. You do not want to get into a situation where you die without a will and you have these assets, because now this is going to create fights within your family. It can create a whole bunch of issues, and you do not want the state to decide where your money goes. Another option is you can create a trust, which essentially tells the world what you want to happen with your money after you pass. But again, this is what a professional can help you with depending on your personal situation. So you need to have a will or trust. That way you can dictate how your assets are going to pass. Second, if you are building your wealth and you don't have this wealth built yet, you need to have some sort of life insurance in place to protect your family from a tragedy. The way life insurance works is if you were to unexpectedly die, then life insurance will come in and they will take care of your family financially because you're going to buy this policy. So let's say you buy $1 million policy, you're going to be paying this policy every single month, either for a certain number of years or for the rest of your life, depending on what kind of plan you get. And so you're buying into this policy, and if you were to unexpectedly die, then life insurance is going to come in and they're going to give your family a big check. So if you buy a $1 million policy, they're going to come in and they're going to give your family a $1 million check. Personally, I look at life insurance the way I look at car insurance. It's there as tragedy protection. It's risk management. It is not something that you want your family to rely on to survive after you. Your goal should be to invest your money and build wealth with your own assets. And if something tragic were to happen along the way, that's when life insurance comes in as that bridge, and they can come and take care of your family, because you never want to run into a situation where somebody who is a breadwinner of a family tragically dies, and now this family already has to deal with this heartbreaking loss, but now they don't have a way to pay their bills. And what I think a lot of people overlook is how affordable life insurance can be. Like if you are a healthy 30-year-old male, you can get $1 million life insurance plan for something like $30 a month. So you pay $30 a month, and if you were to tragically die during the term of this life insurance plan, then the life insurance policy will kick in and they will pay your family $1 million. Now, if life insurance is something that you're interested in learning more about, then I recommend you checking out our sponsor, Policygenius. I like Policygenius because they don't make you deal with pushy salespeople. All you have to do is go onto their website and enter in a few pieces of information, and then they're going to present you with different life insurance quotes from different companies. That way you can make sure you're getting the best deal possible. And if you do have questions about life insurance, they have experts that you can talk to at any time, and these people are not incentivized to upsell you anything. Plus, they stand by what they do. If you go out and you find a lower life insurance quote anywhere else, just show it to Policygenius and they will give you $100 just for wasting your time. So if you want to learn more and get a free life insurance quote in just a few minutes, I got the link to where you can do that with Policygenius in the description below. Minority Mindset is a partner with Policygenius, so if you use them, we will get compensated, but there's no additional cost to you. So if you want to learn more and get a free quote, I got the link to where you can do that in the description below. There are two things certain in life: death and taxes. If you are making money, you need to pay taxes. And even if you think you're not making enough money to really pay taxes, you still need to file a tax return, because that's just the way the government works, okay? If you do not pay your taxes or you do not file your taxes, it is a big issue. You can go to jail for doing that, so do not play that game, okay? If you are making any sort of money, you have to file a tax return. If the money you're making is just coming from your job, then you can use one of those online tax filing softwares. They're very cheap to use, and a lot of times they might even be free, and they will walk you through all the different deductions and exemptions and credits that you can get. That way you can pay the least amount of money in taxes. So if you have just a simple tax return where you're just making money from your job, then use one of those online things, because that's going to be the most cost-effective ways to go. If you get a little bit more sophisticated, like now you're investing in real estate or you have other businesses that you're a part of, that's when you really want to start looking about getting your own accountant, because an accountant's job is now to manage your bookkeeping and check the numbers and see how the numbers are going, and then find you the most deductions that you can get. That way you can pay the least amount of money in taxes. When I was in law school, I spent a lot of time and I took a lot of classes on taxes. The tax code is thousands of pages long. It is not worth your time to try to find every single deduction. Hire a professional, that way you can save the most money on taxes, and that way you don't have to deal with the headache. Now, if you get to this point and you ask yourself, wow, if only there was a way to fast track my way to wealth, well, there is. Once you know how to use your money, which is all the things that we just talked about, then you can fuel the system by adding more money into the system by earning more money. The simplest way to make an extra $5,000 to $10,000 a year is just by asking your boss for a raise. So if you think you've been doing a good job and you've been working at your place for a while, then you can go to your boss and demonstrate the value that you provide and show how you're going to make the company more money and show how you can take on more responsibility, and in exchange you can ask for a raise. That way you can make more money. For some of you, that's not going to be an option because you can't stand your job, or you don't want to put any more effort into your job or whatever, so you might want to consider getting a side hustle. So there's a lot of different ways you can do this. If you are really a big fan of the internet, you can become a virtual assistant, you can be a freelancer, you can do design work. There's a lot of things that you can do on the internet to make extra cash, either by doing something, creating something yourself, or by creating services and offering these services to other businesses that need them. The advantage with this is you can do these side hustles usually on your own schedule and on your own time and wherever you want. But the downfall is it takes more effort to get started. Like if you get this raise, then you just keep doing what you're doing and you're already making this more money. With a side hustle, you have to go out and really earn this money, so it can take you weeks or months or maybe even a year to start making money, depending on your effort and depending on how good you are at what you do. And if that's not good enough, then you can go out and you can consider starting your own business, or you can consider investing in somebody who's starting a business. So starting a business obviously has the most risk because the majority of small businesses fail. I can tell you from first-hand experience that starting a business is hard work, and you're not going to see the returns that you want immediately. It takes years to really get any return out of starting your own business, if you get any return. But if you feel like you have the entrepreneurship bug and you really want to be a business owner, then this is an option for you, and you really just got to go out there and start, and this can give you the opportunity to earn more money, but is not guaranteed. And finally, number 10, check yourself. Kind of like what we hinted at in the beginning of this video, where you took out a piece of paper and you looked at how much money you had coming in and you looked at where all the money was going out. You need to make sure you keep doing that every single month, because you want to make sure that your money is staying on track. This is not something that you can just do once and then hope for the best. Being wealthy and building a financially healthy lifestyle is a lifestyle. It's something that you have to do forever. Every single month, pull out a piece of paper, look at how much money you had coming in, look at how much money you had going out, and compare it to your goals. When something goes out of whack in your finances, it can mess everything up. Like in 2019, Americans paid something like $11 billion in overdraft fees. That's money that Americans didn't have because they spent money when they had no more money in their bank account. You need to be the CFO, the Chief Financial Officer of your finances. So see how much money came in and see how much money came out and make sure everything is adding up. Now, before we get into the next clip, I do want to let you know that if you are interested in learning more about money management and investing, our team has put together an amazing guide that will walk you through the things you need to know about managing your money and starting to invest your money the right way. That way you can build your wealth. This guide is completely free when you sign up for our daily newsletter. So if you want to download this free guide and start reading our daily newsletter, I got the link to how you can download it for free in the description below. If you're like most people, you grew up and told that if you want to become successful, you got to go to school, get a good degree, get a good job, work really hard at your job, save some money in your 401k, and then you will be able to retire wealthy, or at least hopefully financially free, or at least be able to retire. I always wanted to be financially successful. My parents are immigrants from a state in India called Punjab, and I saw how hard they worked, and so I wanted to be financially successful. That way I could give back to my parents and I could take care of my family because I saw the hardships and the struggles that they went through. But I started to look at things differently than what everyone said that you should do when one day I was in college and I was sitting in the library and I was like, let me just take a look at the Forbes richest person list. And over there, you have people like Warren Buffett, Mark Zuckerberg, Bill Gates, and I'm looking at these people and what they do. And what's interesting is none of these people follow that traditional path that everybody tells you to follow to become wealthy or to become successful. Now, I know not everybody can be the next Mark Zuckerberg or Elon Musk or Bill Gates and build a multi-billion-dollar business. I'm not saying that's what you should do. But there are many ways for you to become wealthy and retire a millionaire that many of us never learn. Actually, a lot of the financial advice that we get from the people around us is the reason why so many people are broke. Now, when it comes to really understanding money, there are three main points that I need you to understand that most of us have been completely lied to about money. And these are the three things that I'm going to be talking about in this video. But before I do that, I need you to do me a quick favor and smash the thumbs up button below. The first thing that all of us are taught about money is that money must be earned through labor, and this is one of the biggest lies out there when it comes to money, and this is a big reason why a lot of people will never become wealthy. Growing up, this was the only thing that I saw. My parents were immigrants, like I said, and so when you come to a new country with not that much money, where you don't speak the language, where you don't know the culture, you have to hustle to make it work. And so my dad had this thing where he would say there's no such thing as sick days, because if you take a sick day, that means you're not going to work. If you're not going to work, you're not getting paid. If you're not getting paid, you don't have money to eat. Now, I was very fortunate. I was never poor. I never had to worry about where my next meal was going to come from. But I really understood the value of working hard because in my mind, the more you worked, the more money you would make. And it was to the point where if my parents had a Saturday and a Sunday off, a whole weekend off, this was considered a long vacation. But this method of earning money is how we're all taught to earn money. Here's how it works. Here's you right here. Gotta draw you, a nice mustache, or for our female audience, draw you a nice braid, or as we say in my native language, a gut. So here's you, and here is your job. And so what do? You go to your job, and every time you go to your job pays you a paycheck. Now, if you want to earn more money in this system, what do? Well, you go and get a good degree. Or you go and get a certificate, you get a master's, you become a doctor, you become an attorney, you become an engineer. So you get a better job to get a higher paycheck. But at the end of the day, it's still labor. Sure, maybe it's not physical labor, but you're still working. You go to a job every single day to get this paycheck. If you have a better job, you make more money. But this is where kind of one of the disconnects are about money, because yes, you can make money here, but this is not the only way to make money, because this is one of the biggest misconceptions that I had, because I always assumed that if you wanted to make money, You had to go to a job, you had to do a task, you had to do some work in order to get paid. But it doesn't work like that. Wealthy people and rich people do not make money in the system. Sure, maybe that's how they started off, or maybe this is how they attract some money, but that's not the only way they make money. What every single wealthy person does is they understand that they do not want to earn all their money through their labor, because there's a limit to how much you can work. There's a limit to how many days you can work. There's a limit to how many hours you can work. And so what they do is they take this money right here. We'll call this your EI, your earned income. This is money that you have to go work to earn. And now they're gonna make this money, and they're gonna put some of this money aside right here. And they're gonna take this money and they're gonna put it to work somewhere else for their PI, passive income. Because there's a difference between your earned income, where you have to go to a job, or where you have to go to your business, where you have to do something to earn money, and your passive income, where your money goes out and makes you money. This EI, this earned income right here, is not gonna make you rich. I don't care what job you have. I don't care if you're a doctor. You are never going to become rich just with your salary right here. What you need to do if you want to become wealthy, this is whether you're making $25,000 a year or $2.5 million a year, is you got to take some of this money aside and you got to start putting it towards your passive income. This is what wealthy people do. Wealthy people take as much of this money here and they put it here, because they understand that this is not going to make you rich. Because it doesn't matter how much money you make, as soon as you stop working, the money stops coming in. And so if you look at really what becoming wealthy is how much freedom you have. Here, it doesn't matter if you're running a business or if you have a job. It doesn't matter, because now if you stop working, you stop getting paid. Now, this is assuming that you don't have a big business where you don't have to work in there to get paid. But if you have a small business, or if you're working a job, you have to work to get paid. Now, what you got to do is you got to take this money, put it here. That way now you're getting paid even if you don't go to work, even if you don't do a specific task. And this is where real wealth is built. When I realized this concept, that was when I changed my life completely, at least financially, because I stopped working just for this. Before, anytime I made money, I'd want a nicer car. I'd want to upgrade my car. I'd want a new watch. I'd buy all these nice things. But when I realized that my money could fund my lifestyle, not just by making money and spending it, but by making money and using it the right way, by buying investments, assets, real estate, stocks, things that pay you, then I started changing what I did with my money. Instead of buying cars and watches, I started buying real estate. And these were things that started paying me with cash flow. And so what I understood was, if I made enough money here from my passive income, then I could fund my entire life without making any money here. So it was a big shift in my mind, and this is where a lot of us are never taught that you can make money outside of just your job. In most of our minds, we think, okay, if we want to make money, what do? Well, we can get a job, we can start a business. But both of these are going to require a lot of work on your part, and if you don't work, you don't get paid. But you have to get paid even if you don't work, if you want to become wealthy. The way you do that, you get paid, whether it's from your job, your business, whatever, you get paid, you have to put money here. Now, I'm not going to be getting into investing and how you do that in this video, because I got other things I want to talk about. But if you do want to learn more about how you can start investing in real estate for cash flow, I already made a video where I explain all that, and I'll link that video for you in the description below. This system is why you have some doctors that are broke, and you have some people making $30,000 a year that retire wealthy. Because when you live off of this, you will never be able to build wealth. But when you work to grow this so you can live off of this, you will become wealthy. And so what you want to do is stop living off of this and start living off of this. The second wrong thing that we're all told about money is that money is evil, or some sort of variation of this. Like in my house, money wasn't something that we really talked about, because in my culture, you don't really talk about money in that way. Like, it's just kind of something that you just kind of assume is going to be okay. You don't talk about money. So at the same time, I know when I was growing up, my parents always told me that if I wanted to become successful, I should become a doctor. But we never talked about money management or investing or saving, because these things were kind of just bad and distractions. So we never talked about money. And anytime I did, I was always told, don't worry about money. It will be okay once you are a doctor. But here's the thing. In my culture, I'm going to keep it just completely real with you. In my culture, we don't talk about money, but at the same time, we have so many people drowning in debt. We have so many people that do not understand how to spend their money. We have so many people blowing their money on nice cars, but now do not have any money for their investments. We have so many people blowing their money on the wrong things and do not have a way to afford a decent lifestyle or afford a good education for their kids. And so we have all these kind of like confusions in the way that people use their money, and it all comes down to this, because we are scared to talk about money. But the reality is we have to start talking about money. That way we can start being good with our money. That way we can start building wealth for ourselves instead of making everybody else around us rich. And the unfortunate thing is the media does not help with this. The media, especially nowadays, we really start to see this kind of like divide between the rich and the poor. And anytime you hear people talk about someone rich or a corporation or whatever on the news, it's always portrayed as this evil person, right? Because rich people are evil in the media. But the thing that you have to understand is money at the end of the day does not make you a good person. Money does not make you a bad person. Money is just a tool. Okay, it does not make you bad. It does not make you good. It is a tool that you can use to take better care of your family. It's a tool that you can use to take better care of your parents. It's a tool that you can use to take better care of your spouse. It's a tool that you can use to take better care of your community. We live in this culture right now where people hate rich people. Why? Because they're rich. And this is where we have to kind of start breaking out of this mold and take a step back and say, why are we thinking like that? Why do we think this person's rich? Because they have become successful? Maybe instead of us hating on success and this richness or whatever you want to call it, how about we figure out how this person became successful so we can do it too? Because being broke has never helped anyone. Period. Okay? You can help more people if you have money. Money is just fuel. It amplifies what you do. If you want to feed hungry people, having $1 million can help you feed more hungry people. If you want to do more community service, sure, you as a person can do that. But if you have $1 million with you, you can do a whole lot more community service. Okay? So money is just fuel. It doesn't make you a good person. It doesn't make you a bad person. It amplifies who you are. It allows you to do more of whatever it is you want to do. I realize I never changed this 1 to a 2, so let me do that right now. Look, at the end of the day, money is just one part of your life. And yes, there are things that are way more important than money. Like, you gotta be physically healthy. If you're on your deathbed, it doesn't matter how much money you make. Because if you're about to die or you're so obese where you can't live your life, it doesn't matter how much money you have. You gotta be mentally healthy. If you're depressed or you have all this anxiety so you cannot even live your life, it doesn't matter how much money you have if you cannot live happily. You have to have spiritual health. That doesn't mean you have to be religious. When I say spiritual health, I mean you gotta have a purpose in your life. You gotta have a reason to get out of bed in the morning. If you don't have a reason to get out of bed, you can have $10 million in the bank, but it doesn't mean anything because you don't have a purpose to your life. Once you have the physical fitness, the mental fitness, and the spiritual fitness, now is when being financially healthy is the most beneficial. But this is where everyone gets things screwed up because everyone says money doesn't buy happiness, so don't worry about money. Yeah, money is not going to buy you happiness, but being broke is not going to make you happy either. Money can help buy you the things that you want to do. That way you can do things that make you happy. And money can buy you freedom, but you got to understand where money plays a part in your life. And when you just put up the smoke screen by saying things like money's evil, so you don't got to talk about it, now you're just ignoring the issue and you're living in fairy tale la la land. And this brings me to number 3. And for the purposes of this one, I'm going to call this our dollars money. The third thing you got to understand, which is one of the biggest lies that we're told, is that this money is real money. When I was growing up, I had never heard of the word investing. No one in my family was a real estate investor. No one in my family knew a real estate investor. And so for us in our household, money management and being financially smart was working hard at your job, working as hard as possible, and then saving as much money as possible. And so you work hard, save as much money, and what do you do with the savings? You let those savings sit in the bank. You know, I've joked around about this before because there's a lot of difference between the traditional Indian culture and American culture, because in the Indian culture, people make $1 to spend 20 cents. In the American culture, people make $1 to spend $2 with the help of credit cards and loans and lines of credit. And so in that kind of traditional Indian culture, we have this kind of like saving bread into our blood. And so my parents were the same. They worked very, very hard, and then they saved as much money as possible, thinking that it was the financially smart thing to do. Now, it is better to save your money than to blow it at Gucci and Louis Vuitton and buy a whole bunch of nice things. But there's so much more to what you can do with your money, and the only way you're gonna do that is if you understand what money actually is. These dollars right here are just pieces of paper, and it only costs 12 cents to print a $100 bill. I don't have a $100 bill on me, so I'm gonna show you a 50, but it costs 12 cents to print a $100 bill. And so this piece of paper now can be printed as much as the government and the Federal Reserve wants, and as more money gets printed and enters our circulation, the value of each dollar that you save and the value of each dollar that you earn now gets diluted. So if you were making $3,000 a month and more money gets printed, that $3,000 a month in a few years is not going to have the same buying power that $3,000 a month does today, because $3,000 a month in a few years is going to be more diluted because of all the dollars now in circulation than $3,000 a month does today. And so what happens? The price of your rent goes up. The price of your groceries go up. If you want to go on a vacation, your vacation costs go up. Gas prices go up. And so the prices of everything around you keep going up, while the wages don't necessarily keep up with now the higher cost of living and the higher standard of living. The average person's financial advice is work hard, make money, and save whatever you can. And this is the reason why most people will never become wealthy. A wealthy person would never follow that financial advice. A wealthy person is going to work hard, take whatever money they can and invest it, and only save what they need. A wealthy person is only going to save money for 3 reasons. They're going to save money for an emergency. And so now you got to have an emergency fund. This might be 3 months worth of expenses, up to a year's worth of expenses, depending on how conservative you want to be. A wealthy person will save for big purchases. This might be a home, this might be a car, and a wealthy person will save to invest their money. If saving your money does not fall into one of these 3 categories, you gotta do something with that money. This goes back to what I was talking about earlier, where financially educated people will take their money, their earned income, and they're gonna convert it to passive income. Well, it comes back to this right here too, because when you make money and you leave it in your bank account, your money stays flat. It's dead. But at the same time, the price of everything else keeps getting more and more expensive. So your money in your bank account is dead, but everything else keeps getting more expensive. So you are effectively becoming poorer and poorer day by day. That's why what wealthy people do is they take this money and they convert it to something else. They convert it to assets. This might be stocks. This might be real estate. Things that now make them more money. When you own shares of a stock, now you own a piece of a company, and this company's working hard to make more money, and as the company makes more money, so do you, because your stock price goes up or you get dividends. When you own real estate, you own a physical property, or if you're talking about crowdfunded real estate or something like that, now you own exposure to real estate. But when you own real estate, you own a real piece of property. You own brick, you own land, you own windows, and now if a tenant is living there, they're gonna be paying you rent every single month. So you have a stream of cash flow and you have a physical building. And so now you have real assets that are worth something because you own shares of a company or you own shares of a building. When you own money, just cash, just pieces of paper, you own pieces of paper that are losing value every single day. That's why you got to understand why you're saving money. After you get past that, you got to convert your cash to something real. I get it. Some of the stuff is going to seem really weird and really out there, especially if you haven't been exposed to financial education before. But this is the reality of what's going on. If you are not happy with where you are financially, if you are struggling paying your bills, if you are struggling paying down your debt, if you do not know how you can be financially free, it is possible, but it starts with financial education, and it's tough because none of us are taught about money or financial education when we're in school. This is where you're gonna have to be the one to go out of your way to learn this financial education and then actually put it to action. But lucky for you, it is easier now than ever because there's so much information that you can access for free, literally on your fingertips. And if you're looking for a place you can learn, you can subscribe to our YouTube channel because we talk about this every single week. The stock market is a place where you can go and buy shares or ownership in some of your favorite companies. Amazon, Chipotle, Lululemon, Amazon. When you invest in their stocks, you get to own a piece of the company. That way when they make more money, so do you, because the stock price goes up. When you invest in real estate, you're buying physical properties. Like you can go out and buy a home, and then you can put a tenant in that home, and every single month, this tenant will pay you rent for living in your property, and now you have a cash flow producing asset. Now here's the thing, while these things sound nice, it's not always as easy as it sounds. I mean, everybody likes the idea of owning their favorite company, But why is it that so many people lose money in the stock market? And everybody likes the idea of having rental properties, but why is it that so many people cannot manage rental properties, or at least can't do it profitably? That's why in this video, I'm going to be going over 5 things, 5 secrets that you need to understand. But before I get into that, I need you to do me a quick favor and smash the thumbs up button below. And a quick word from our sponsor, Fundrise. If you are interested in investing in real estate, but you don't want to deal with the headache of managing a rental property, you don't want to deal with tenants, you don't want to deal with contractors, then you can invest in crowdfunded real estate with as little as $1,000. And if you want to see how you can get started, I got the link to how you can do that with our sponsor Fundrise in the description below. The first thing you got to understand is the importance of money conversion. So anytime I go to India to visit my family, the first thing I do is I go and I convert some of my dollars to rupees, because in India people do transactions with rupees, not dollars. When it comes to you building your wealth, you have to convert your money, your dollars, into something that is going to make you more money, because the reality is the dollars that you have, the dollars that you work so hard to earn, and the dollars that you save in your bank account are losing value to inflation, because as more and more money is printed, the value of each dollar that you have gets diluted. So what you want to do is you need to be converting some of your dollars, your paper dollars, into assets, investments that will make you money. So in this case, we're talking about stocks and real estate. And the thing that you need to understand here, so I'm going to assume that this side of the equation is your stocks and real estate. These are your assets. So what you want to do here is you make your EI, your earned income. This is the money you make from your job or the money you make from your business. And you want to take as much of this money as possible and put it here towards your PI, your passive income investments, because this is the thing that will make you wealthy. What wealthy people do and financially educated people do is they take as much of this money here and they put as much of it as possible here, because this is what is going to make you wealthy, not this. Doesn't matter how much money you make. I don't care if you're a doctor. You will never become wealthy just with the salary you make from your job, because as soon as you stop working, you stop getting paid. So what you need to start doing is, as soon as you get paid, you need to start transferring this money here towards your passive investments. That way you can start making money without having to physically go to work. Because if you want to become wealthy, your money has to be generating you money. Because if you have to work every single day in order to fund your lifestyle, you are not wealthy. You have no freedom. The reason I'm talking about this right now is because for any of the things that I'm about to talk about to work, you have to have the money to actually invest. And now how do you get that money? Well, now when you get paid, you want to take as much of this money as possible. I like to say a minimum of 15%, but the more the better. You want to take as much of this money as possible and put it towards your investments. In this case, stocks and real estate. I'll talk about that in just a second, but this is why it's so important, because you're never going to build wealth with this. You're going to build wealth with this, as you want to convert as much of this here as possible, because this money, even if you just save it, is losing value and is making you poorer each and every day, because the value of your dollar is dropping while the price of everything else keeps going up. That's why you want to move this money here, because this is going to make you wealthier, this is going to make you more money, and this will happen on the side without you having to physically go to work or do something to get paid, because you're putting your money in the right places that's going to pay you for owning it. If you are a newer investor or you haven't started investing yet, this concept is going to seem weird, because it doesn't make sense how you can make money without getting paid. I went through the exact same thing. I didn't grow up learning about investing or passive investments or stock market investing or real estate investing. I just thought that if you wanted to become wealthy, you need to get a better degree. That way you can get more money here. You can get a better job so you can make more money. But when I started investing in real estate for the first time, I bought a small condo out of foreclosure and I rented it out for $600 a month. This was the first investment that I made here ever. And this condo, after paying all of my expenses, was putting like $250 a month into my pocket every single month, and I didn't have to do any work. I had a property management company handling all the day-to-day stuff, and every month $250 was being deposited into my bank account, and I didn't have to do anything to earn that money. That was when the gears really started to turn in my brain, because I never knew that you can make money without physically having to go to work or do something to get paid. I didn't know that your money could be the one making you money. And this is what you got to understand, that wealthy people work on making their money here, while broke people focus on just growing this. Yes, if you have more money here, that can help you grow this, but what you have to remember here is you want to take as much of this as possible and move it here. That way you can become wealthy. It doesn't matter if you make $25,000 a year or $250,000 a year. You can start with whatever you can. Take as much of this and move it here as possible, because when you can build this, you will be wealthy. It's not going to happen overnight. This is something that's going to take time, but you need to start by taking some of this, the money you make from your job and your business, and move it here. That way you have these passive investments that will pay you forever. The second secret that you got to understand is equity. So when most people think of equity, they think of their homes. I own a home that's worth $100,000 and I owe $80,000 on my home, so I have $20,000 equity in my home. But when it comes to investments, this becomes just as important, because if you don't have any equity in your investments and things go wrong, which they will happen. The thing is about stock market investing and real estate investing, things will go wrong. Sometimes the economy will go down. Sometimes the stock market will crash. Sometimes the real estate market will crash. And sometimes your tenant's not going to pay you, or the company that you're invested in is going to struggle. And so you got to understand that things will go wrong. And if you have no equity in what you're doing, then you have no margin of error. And if things go wrong and you have no equity, now you're going to be the one paying the price, and you're going to be the first person to lose your shirt. Now, if you spend any time at all on the internet looking for ways to become wealthy through your investments, by now you're probably getting ready to type, "But Jaspreet, I've heard of so many people becoming rich with no money down real estate and by using high margin investments in the stock market." Let me start by talking about no money down real estate, okay? The way no money down real estate works is kind of like this. So there's this home right here, and this home, let's say, is worth $100,000, and the bank is willing to loan you $80,000. Now, you have to come up with the other $20,000 somehow, and you can take this $20,000 from your own personal account, or if you don't have $20,000, you can go to the seller of the home. So let's say this is the seller right here, Madame, a nice mustache. And so the seller says, "Hey, you know what? You seem like a trustworthy person. How about I loan you the other $20,000? So now the seller loans you $20,000, the bank loans you $80,000, and you buy the home with next to nothing. Sure, you might have to pay the closing costs, you might have to pay some other renovation costs, but in general, you're buying this home with very little money, with the hopes that now someone else, let's say this tenant right here, is gonna move in and they're gonna pay you rent and they're gonna cover all your costs. In theory, this looks great. You have very little money out of pocket, and if the numbers work out, you're gonna have some profit coming into your pocket every single month, and you had to put up very little money. But here's the reality of how this works. When the economy is growing, and when home prices are appreciating, and when tenants have money to pay rent, this is good. So when things are good, you can make money doing this. But as soon as things slow down, you are going to be the first person to not have money to pay your bank because you have so much debt on your property. You're going to be the first person to not be able to renovate your property and make the property nice when tenants want a better home. You are going to be the first person to go bankrupt or file for foreclosure when a tenant damages your property and you don't have money to make the renovations. These no money down deals are good sometimes. Yes, they have made some people rich, but do you want to know something else? These no money deals have also made me a lot of money, because when this person buys this property with no money down and then something goes wrong and then the bank has to take the property away from you and they sell it to an investor for a below market price, that's when I come in and I buy the property because you were not able to take care of your investment property. So yes, no money down deals can work, but they come with their own fair share of risk. And if you have never invested in real estate before and you don't have any savings cushion, then you are going to be the first person to lose your shirt when things go wrong, and then somebody else, a more savvy real estate investor, is going to come in and they're going to buy that property off of you for pennies on the dollar. You see the exact same thing happen in the stock market. You'll see people offering these classes on how you can get rich trading options and doing day trading and doing this other short-term trading, where now you're trading with 10x margins. So you invest $1,000 and then you borrow $10,000 from your broker, and now you can invest with so much more money than you actually have. And when things are going up and the market is growing, it's no problem because everybody's making money, and now you're making money hand over fist. But as soon as things slow down and things start going down, now you're going to be the first person to lose everything, because now not only did you lose everything that you have, but now you owe your broker money that you don't have. So the thing that you have to understand about equity as an investor is, if you take on more debt, yes, you can make much more money very quickly. That is a fact. but it also comes with more risk. So if you have never invested your money before, or if you do not know what you're doing, then you're taking on more risk without the experience. So that's something that you got to understand. Yes, it is possible. You can make a lot of money doing this if you have cash reserves and if you know what you're doing. But if you don't know what you're doing, then you got to understand you're taking on a lot of risk without understanding what you're doing. And the second thing that I want you to understand about equity as an investor is if you want to build wealth for the long term, you have to plan for things going wrong. One of the ways you can do that is by having some equity in your deals and having equity in your investments, because now you have a margin of error, because guess what? Things will go wrong. The market will correct. I don't care if you're talking about the real estate market or the stock market. Things will correct. Things will go up, things will go down, and you want to be able to weather whatever happens. And the best way to do that, or one of the best ways to do that, is just by having some equity in the deals, meaning some of your own money in the deals. So you're taking some of your earned income, putting it to your passive income here with real estate or stock market. That way when things do go down, you have equity to protect you. The third secret, which really should not be a secret, is if you want to become wealthy, you got to understand the game and you got to keep learning. I mean, we have a lot of new investors entering the market right now in the real estate space and the stock market space. And the thing that always kind of concerns me is when someone starts investing their money, but they have no idea or no plan on how to invest their money. And now they go out and they start teaching people on how to invest their money just because this one person has made their first $10,000 or first $100,000. And the thing you have to understand here is that when the market is going up, it is very easy to make money. Anybody can make money in a bull market. And so everybody thinks they're a financial genius when the market is going up. But the real test of who's a good investor and who's not is what happens when things turn around. And so this is where you gotta understand the game and you gotta keep learning, because this education is what's gonna help you build wealth over the long term. I'm gonna talk more about that in number 4, but you gotta understand how the game works. I'm gonna start with real estate, then I'm gonna go to the stock market, then I'm gonna go back to real estate, and then go back to the stock market. You'll see why I'm gonna follow that order in just a second, but here's how it works in real estate. Let's say you buy this home right here. I'm gonna stick with the example where you paid $100,000 for the home, and now your goal with real estate is cash flow. You want a cash flow producing asset, which means you're gonna make money every single month from rent. So in my area, I'm looking for a 7% return, which means here I'm making $7,000 a year in profit from this property, assuming I had to put in $100,000. So I put in $100,000, and every single year I get $7,000 a year in passive cash flow from this property. In the stock market, it's a little bit different. In the stock market, I'm looking for appreciation. So I might invest in this company right here, Company X. Now you could put in whatever company you want. Chipotle, Apple, it doesn't matter. You are putting your money in this company with the hopes that this company is gonna use their money smartly and they're gonna become more valuable. So you're gonna hope that this company makes a bigger profit, they make bigger revenue, they create more products, and that this company makes more money. If this company makes more money, then the stock price will hopefully go up because more people will want to invest in this company. And if you have more demand for the shares of the stock, the price of the stock goes up. And now you just made more money because your stock price went up. So here we're talking about appreciation. Here we're talking about cash flow. Now, there is ways to make cash flow on the stock market side of things if you invest in dividend paying stocks. So some companies in the stock market have a lot of cash, and these are your bigger, more mature companies. So companies like Apple, Verizon, AT&T, these companies, at least at the time of recording this video, are very large, and at the end of every year, they have a lot of cash sitting in their bank account and they don't know what to do with it. So one of the things that they do in this case is they just give this money away to the shareholders, people like you, in the form of dividends. So here, every 3 months, you get a check from these companies just for investing in them. So there is a way to get cash flow in the stock market through dividends. But in general, when people talk about investing in the stock market, they're looking for appreciation. When we're talking about real estate, people are talking about cash flow. So this is the investing side of things. But there's also a way to be a trader both in the stock market and the real estate market. Going back to the same example, let's say now you bought this home for $100,000 and then you put in another $20,000 of renovations. So you upgraded the kitchen, maybe you upgraded the bathroom, and now this home is worth $150,000 and you sell it. Now, you are no longer an investor because the definition of an investor is you're holding on to a property for the long term, which typically is a minimum of a year. Here you want to get in and out as fast as possible. You bought the home, you did your reservations, and now you're flipping it, and you made good money. You made $30,000 in this case. You got to subtract your expenses, your closing costs and all that. But in this case, you're making like $30,000 just by flipping this property. So this is not investing, it's a way of flipping. You see the same thing in the stock market. So in the stock market, you can buy a stock and you own it for 20 minutes. You own it for 2 days, you own it for 2 months. And so you're buying the stock with the hope that it's going to go up quickly. That way you can sell it for a quick profit. This is trading. This is not investing. And so this is where you got to understand the game. And you see this more often here with the stock market than real estate. But a lot of people don't understand why they're buying or what their strategy is. Because you have to understand, what are you doing in the stock market? What are you doing with your money? Are you looking to make money over the next 10 to 30 years? Or are you looking to make money in the next 12 months? And so you have to have a strategy. And when you go in, you have to be willing to stick with it. Because what happens to a lot of people is they come into the stock market and they think, I'm going to be a long-term investor. I find a few companies that I like, I invest in them because I believe in these companies. 6 months later, something goes wrong, my company's down 5%. Now I panic and I sell. And so you went from being a long-term investor to being a trader because things didn't work your way. And so you got to have your strategy in place. You got to understand the game. I put game on the inside of this, but it's supposed to be on the outside. But you got to understand the game. How are you looking to make money? And even within this, there are so many strategies to trade. There's day trading, there's swing trading, there's momentum trading. So you got to understand, what are you looking for? And you can't just be flip-flopping strategies, because most people's strategies when it comes to investing money, especially in the stock market, is I'm going to put my money in what I like and hope that I make money. Hoping you make money is not a strategy. You got to understand what your strategy is before you put your money in. And this is the mistake that so many new investors make, because they're just looking to make money quickly, or they're just looking to make money. And as soon as things go wrong, they panic, they switch strategies, and things just flip. So if your goal is to be a long-term investor, then what you need to be doing is you got to find the right companies or the right ETFs that you want to invest in. And now you got to be listening to the earning calls. And if the company or the fund that you invest in is continuing to produce value and you continue to believe in it, you should continue to hold on to your investment. And even if things go down, the only thing that you should be doing is buying more, because you believe in the underlying fundamental value of your investment and you're looking to make money over the long term, not over the next 6 months, not over the next 2 years. And so if that is your goal, then you got to keep investing in your company, your ETF, because you're investing for the long term, not the short term. Here, if you're looking to make money quicker, if you're looking to be a trader, then you got to have your risk parameters in place. What happens that you got to sell? When are you going to sell? If your company falls more than 10%, you have to have the risk parameter in place. If you tell yourself that you're going to sell after it goes down 10%, you have to sell, because just because you made a smart investment doesn't mean it's going to go up. And so you just have to have your risk parameters in place and understand what rules you have set for yourself. This is something you have to do before you actually start investing, because if you start investing and then you start to set rules for yourself that, oh, I'll sell after I make a 30% profit or after I make a 50% profit, then what ends up happening is your stock goes up 30%. Then you say, now maybe I'll sell it after 50%, because now you're getting greedy. You see the stock shooting straight up and you think it's not going to slow down. I think it's going to go up 50%. Then at 50%, you're going to say, you know what, I'll sell it at 70% profit. And then it goes up to 65% and you're thinking just a little bit more, and now I'm going to sell. And that's when things turn around and now you start losing your profits. And so you got to have your parameters in place beforehand, because when you start setting these parameters after you invest, now the emotion kicks in. You get greedy when things go up, and you get emotional and you panic sell when things go down. You got to know, when do you sell when things go down, and when do you sell when things go up? When you're investing in real estate, especially here, you got to know what your goals are. For me, I got to make a minimum 7% return. And so when I look to invest in properties, I'm looking for an area where money is flowing to. So I can talk to the city, I'll do whatever other research I got to do to see where businesses are going. If I find an area that I like, that I think is going to be more valuable in the future, then I'm going to look for properties that's going to make me a 7% return. If it doesn't make me the 7% return, I'm not interested. I don't care what this property could be worth in the future, because I'm not investing for appreciation. I'm investing for cash flow. Now, if I get appreciation, that's great. I want to find an area where the demand is going to go up, because I want the rental values to continue to stay the same or go up. So I want to make sure I can continue this appreciation. And if I get the appreciation, great, but this is what I'm investing for, not this when I'm investing in real estate. So you got to understand the game before you start investing, because if you're just throwing your money around hoping you make money, Well, now you're the one that's losing money, making everybody else money. The fourth secret that you gotta understand when it comes to building wealth with stocks and real estate is patience, and I left everything here because you're gonna understand how patience plays a part with this. Traders in the stock market and flippers in real estate make more money in the short term than investors do. But over the long term, the people that make the most money over the long term are the long-term investors. And so this is what you gotta understand. What game are you looking to play, and how are you looking to play? Because if you're looking to build wealth over the long term and you're looking to do that passively, you got to do this. Now, you can make a lot of money here. I'm not saying you can't make money here. You can make a lot of money here. But what you got to do is you got to take this money that you make here on the active side with your trading, and you got to move it here into your long-term investments. And so if you want to build wealth, you have to understand that wealth is a long-term game. Yes, you're going to take your earned income and you're going to put it towards a passive income here. If you want to amplify that, you got to make more money. One of the ways you can do that is by trading money, being a flipper. Now, when you make this money here, you got to understand that no market stays the same forever. If you remember, we had 2020 stock market crash, which killed a lot of traders. We had the 2008 real estate crash, which killed a lot of flippers here. And so you got to understand, yes, there's a lot of risk here, but you can make a lot of money very quickly. And so once you make the money here, you want to keep it, which means you want to put it here, because these investments are going to make you money over the long term, and they're going to build you wealth for the rest of your life if you keep funneling that money here and here. Wealth is a long-term game. This is a marathon right here. This is something that you got to plan for the next 10, 20, 30 years. These are sprints. You can make a lot of money with these sprints, but you got to put them somewhere safe, which is the marathon. And so you just got to understand the game, which I just talked about, and you got to understand that the most money is made over the long term, over time. Because when you have time on your side and you have the patience to have time on your side, now you're letting your money grow and you're letting your money compound, which means your money is growing, and the money your money made is going to be making you money, and the money your money's made is now working to make you more money. Your money's money. You know what I'm trying to say. And so it's all about compounding, but that only happens if you have patience, because the issue is we have a lot of people that are looking to make money very quickly. I mean, it's human nature. Who doesn't want to get rich quick? But when you are constantly focused on just getting rich quick here, and you do not have kind of that rational mind, you're just kind of getting greedy because you're looking to make money quickly. Now you're more susceptible for things to go wrong. And when things go wrong, now you're going to be the one paying the price. And so you got to understand what the game is, and you got to understand that if you want to build wealth over the long term, you need the patience, which takes time. And the fifth secret that you got to understand is you got to go all in when the opportunity presents itself. The common saying that everyone has is scared money don't make no money. When you see an opportunity, you have to be willing to jump on it. If you're the one that's just scared, sitting on the sidelines, you're not gonna make any money. When the 2008 real estate crash happened, I was squeezing every dime out of me to buy as much real estate as possible because I wanted to buy these properties at a discounted price. When the 2020 stock market crash happened, I was buying stocks every time that the stock market went lower because I knew that this was another great opportunity. These things are gonna happen again. If you missed the 2008 real estate crash, if you missed the 2020 stock market crash, these things will happen again. Okay, that's the way the market works. Our asset cycles are cyclical. That's why they're called asset cycles. You'll see times when real estate goes up. You'll see times when the stock market goes up. And you'll also see times when these things go down. Now, this doesn't mean that you shouldn't buy them when things are going up. You got to be strategic. You got to be logical. You should buy things when you see good deals, because nobody can perfectly time the market. Nobody knows when things are going to go down. Nobody knows how far they're going to go down for. But when you see an opportunity, whether it's this way or this way, you have to be willing to go all in. Okay? You can read all the books. You can watch all the YouTube videos. You can buy all the courses. But if you're not willing to actually put your money to work, you will never have a chance to become wealthy. And the reason everyone's scared to do this is because they think, what if I lose money? Now, the easiest thing that you can do to get over that fear is just tell yourself you will lose money. Because the reality is, yeah, there will be times where you do lose money. You're going to invest your money in a stock that you think is amazing, and this stock is going to go under, you're going to lose money. You're going to lose money in the real estate market if you invest in real estate eventually. I even talked about my worst real estate deal ever on YouTube. If you want to watch that video, I'll link it for you in the description below. But if you go in with the mindset that your invested money is now gone, right? As soon as you invest the money, it just disappears, you'll be more okay with things when they go wrong. Now, you don't want to just keep losing money, okay? You will lose money eventually, but you got to use them as kind of learning tools But you have to understand that, yeah, it's not going to be kind of riches overnight. And there will be times where things go wrong. But you have to be willing to put your money in. And if you use this as a learning tool, eventually you're going to make your money back plus more. And the loss was just your tuition, your kind of education fees to learn how to actually make money. But the only way you can do that is if you actually put your money to work and if you take that risk. Because if you don't take any risk, you're not going to make any money. I have a feeling that if more people understood how debt worked, then you'd have less people drowning in debt and living paycheck to paycheck. When most of us think about what debt is, we think that debt is just when you borrow money. You go to the bank, you borrow some money, and now you got to pay this money back plus interest. But if you think a little bit deeper, what really is debt? Debt is when you take your future income and you spend it today, and then when you pay this money back, you have to spend your future income paying this money back. So debt is just a way for you to take your future income and spend it right now. And the price that you have to pay, or the markup that you have to pay to spend your future income today, is interest. Now, debt at the end of the day is just a tool. It is a tool that makes banks rich, and it's a tool that makes the majority of people broke. Banks use debt to get rich because banks use debt as an asset because they lend this money out to people, and then people have to pay the bank back plus interest. So to the bank, debt is an asset. But to the majority of people, debt is a liability, because now when the majority of people borrow money, they go out and they finance a car, they buy themselves new clothes, they go on a nice vacation, and so they're using debt as a tool to buy things that are losing them money. Now, there are ways for you to use debt without being a bank that will make you richer and you wealthier. This is what investors do all the time. An investor can use debt as a tool to buy an asset that's going to pay them with cash flow. I'll give you a quick example. Let's say that this is an apartment complex, and this apartment complex is on sale for $1 million. And every single year, this apartment complex generates a profit of $70,000 a year. So these tenants pay rent, and then you pay your taxes, your insurance, your maintenance, your management, and all the other fees, not your debt fees, but all the fees to run this apartment. And there are $70,000 left in the bank account every single year because the apartment complex is making a profit. Now, you might not have $1 million sitting in your bank account to go out and buy this property, but if you can use debt to go out and buy this property, now you can be the owner of this property, and you're gonna have to pay some money to the bank. Now, you might have to send the bank a $55,000 check every single year to own this property, but you had $70,000 worth of profit. So now this other $15,000 difference is yours, and you get to put that in your pocket. So now you're using debt to produce cash flow and more profits and more money in your pocket because you're using debt to buy an asset that's making you money. And if your apartment complex is in a good area and there's more money coming in this area and there's more demand in this area, then maybe in a few years you'll be able to sell this apartment complex for $1.5 million. So now you use debt as a tool to buy real estate, which is making you money every single month. And if it's in a good area, now you can sell this property for a big profit, and this $500,000 profit is yours. You can use debt to buy businesses. Some people and institutions use debt to invest their money into stocks. And so there are ways to use debt to buy assets that are gonna pay you, but the majority of people are using it the wrong way. Now, if you've ever read any finance books or some investing books or watched YouTube channels on investing, you might have heard people talk about good debt and bad debt. Good debt is debt that you use, like I just talked about, to buy assets, things that are gonna make you money. Bad debt is what the majority of people use debt for. This is when you use debt to buy a car, or when you use debt to finance your clothes or go on vacations. That's bad debt because now you're using debt to buy liabilities. I don't like to look at debt as good or bad. At the end of the day, debt is a tool. Even if you use debt to buy assets, it can still turn bad if you don't know how to manage your assets or if you don't know how to run your assets. And so even though you use good debt, that good debt can turn very sour very quickly if you don't know what you're doing. So at the end of the day, debt is a tool. And the more debt you take on, the more risk you take on. And so that's something you just gotta understand. Yes, debt can help you build wealth and become rich very quickly because you can amplify your buying power. But if you don't know how to use your debt, then you're gonna be the one paying the price, literally. The topic that I really wanna focus in on today is we have somewhere between 7 to 8 out of every 10 Americans living paycheck to paycheck. That means every time you make $100, $100 flows out. This can be an issue if you're living paycheck to paycheck the wrong way, because almost everybody is living paycheck to paycheck the wrong way, and I'll explain what I mean in just a second. But before I do that, I need you to do me a quick favor and smash the thumbs up button below. We live in a society where when people want something, they want it now. And when you want something now, when you don't have the cash to buy it, what do? Well, you turn to your handy dandy friend, debt. When you hear people say that Americans are living paycheck to paycheck, what that means is somebody is making $3,000 a month and then they're spending $3,000 a month or sometimes more on all of their expenses. But just because somebody's living paycheck to paycheck doesn't necessarily mean it's a bad thing, assuming you're doing paycheck to paycheck the right way. The issue is nobody is doing paycheck to paycheck the right way except for a very few people. So the issue with people living paycheck to paycheck is people are living paycheck to paycheck here on the liability side of the equation, and they're not living paycheck to paycheck here on the asset side of the equation. A liability is something that loses money. This is what I've been talking about all video. So your car, your shoes, your clothes, your vacations, these things are nice. They make you look rich, but they keep you broke. If you buy something and it doesn't put more money back in your pocket, it is a liability. Assets, on the other hand, are things that you buy for the sole purpose of making money. So an asset might mean a stock. It might mean real estate as an investment. It might mean gold, it might be commodities, it might be cryptocurrency. An asset is something that you're buying for the sole purpose of making money. And so what wealthy people do is they take their money and they spend whatever money they can, not here, not on fancy cars, not on Gucci clothes, not on things that'll make them look rich on Instagram, but they spend as much money as possible here on assets, because assets are what make rich people rich, and it's what keep wealthy people wealthy. If you own assets, that is what's gonna keep your wealth. So when you hear that somebody is living paycheck to paycheck, what that means is over here, they're making $3,000 a month, and that $3,000 a month is leaving right here. All the $3,000 is leaving to go to your housing payment, is leaving to go to your car payment, your insurance payments, your food payment, your going out payment, your entertainment costs. And so you make $3,000, but all $3,000 go out over here. But on the other side of things, the good side of paycheck to paycheck is now, let's say you make $3,000 a month and your living expenses are $2,000 a month, and now you have an extra $1,000 a month, but you don't just sit on that extra $1,000 a month, you automatically invest that $1,000 a month every single month. And so you don't have this extra cash just sitting in your bank account because you're living paycheck to paycheck. Technically, not in the way that most people think about it, but in the asset minority mindset way, because now you make $3,000 and you automatically spend $3,000. You have $2,000 going to your liabilities, your cost of living, and another $1,000 going towards your assets. The problem that we really have as a society is when you hear that 78% of Americans are living paycheck to paycheck, all 78% of those people are living paycheck to paycheck here. And so this is where we have to understand, okay, what is going on and how can we switch this so people can live paycheck to paycheck on this side of the equation by using their money to buy assets. But the majority of people just don't have the ability to do that because all their money is going here. This is where you have to really fully understand the picture and really understand what's going on. Because if you ask the majority of people here, why are you living paycheck to paycheck? Everybody will tell you that it is an income problem. I am not making enough money. If I just made more money, if I made an extra $10,000 a year, then I will have more money to put here. But what we've seen happen time and time again is that as people make more money, they don't have more money going here, they just buy more of these. Because when you get that raise, or you get that bonus, or you get that promotion, what do? Well, now you gotta celebrate. You gotta celebrate with a brand new car. You gotta celebrate with a new vacation. You gotta take your friends out to dinner. And so what happens is people make more money, but then suddenly their expenses go up just with their income. This is where you have to really take a step back and understand what's going on, because everybody's gonna tell you that they're living paycheck to paycheck because they're not making enough money. And now the amount of money you make is a factor, and they can amplify how fast you become wealthy, but it is not the sole factor. Making money and how much money you make is the second part to becoming successful. The first part you gotta understand is how you spend the money that you make. Because if you have Apple AirPods and you're wearing Lululemon leggings, or you have the new Apple MacBook and you have all these nice things, but you're still complaining about living paycheck to paycheck, something's wrong with this picture here. Now look, I know there are exceptions to this rule. Yes, there are people that are living paycheck to paycheck, that are working very hard, that are living very frugally. But there are also a lot of people that aren't. There's a lot of people people that are living paycheck to paycheck, they have a lot of nice things. They drive new cars, they have a whole bunch of fancy things, and they wonder why they don't have any money to put here. So the first thing you got to do is you got to fix the mindset part of finances, because you got to understand what is it that's keeping you broke. Because when your mindset is what's keeping you broke, it doesn't matter how much money you make. No matter how much money you make, your expenses are going to go up just with it, and so you're going to continue to be broke no matter how much money you make. So the first thing you got to do is you got to fix your mindset, and then you got to control your spending. There's 3 things that I want you to do when it comes to controlling your spending. First, stop financing things. If it does not pay you, do not finance it. The only exception to this is your house. So no more going into credit card debt, no more financing things with installment plans and payment plans, no more buying things that you cannot afford with cash. Second, follow my rule of 5. If you cannot buy 5 of them, you cannot afford 1 of them. This is going to help you control your spending, because now you're going to know what you can really afford. Because most people think that, oh, if I got $100 in my bank account, I can go out and spend $100. No, if you only have $100 in your bank account, you should not be spending $100. So the second thing you got to do is you got to follow my rule of 5. That way you can only buy things that you can afford, because there's a difference between being able to buy things and being able to afford things. And third, you got to create a financial system for your money. One of the easiest financial systems that you can follow is our 75-15-10 plan. What that says is for every dollar that you earn, 75 cents is the maximum you can spend. 15 cents is the minimum you should be investing, and 10 cents is the minimum you should be saving. Once you do that, now, yeah, you can be living paycheck to paycheck, because every dollar you're making has a purpose. You don't want any dollars just sitting there kind of with a question mark over his head wondering, how should I be spent? No, you got to be the master of your money. You got to tell your money where to go. And so now, anytime you make a dollar, have your dollar flow through the system. So anytime you make a dollar, 75 cents is the maximum you can spend on liabilities. 15 cents is automatically going to be invested, or it's going to be put aside to be invested. And 10 cents is going towards your savings. This is your emergency savings. Once you have a savings account built up, put that money towards your investments as well. Once you do these 3 things, now you're in the business of controlling your spending. Now you know what it means to live below your means. Now you know what you can afford, and you're not spending all your money to finance things that you cannot afford. Remember, debt is when you're using your future income to buy something today. And so when you're using debt to buy something that's losing money, you are spending tomorrow's money to finance today's lifestyle. You don't need to be a math genius to know that that's a recipe for disaster. Once you got the mindset and the spending side of your equation in check, that's when you can work to start earning more money, because now when you earn more money, you already got a financial system and you already know how to use your money, so you can send more money here. Before I talk about that, if you do want to learn more about how to actually manage your money and use your money the right way, our team put together an amazing PDF, and you can download that PDF for free in the description below. Once you get to this point, this is when earning more money is going to have the most effect, because you know how to use your money. Before, if you didn't know how to use your money the right way and you earn more money, you're going to spend your money the same way you've been spending your money your whole life. Now that you have a system for your money, you want to make sure you continue following this system as you make more money. So if you get a $10,000 raise or you get a bonus, send this bonus through your financial system. So out of this bonus, 75 cents is the maximum you can spend. 15 cents is the minimum you should be investing, and 10 cents is the minimum you should be saving. When you do this, now you're building a system where, yeah, you're still living paycheck to paycheck, but your money is being used in a way that is going to continue building you wealth, because now you're not spending all of your money here, and you're not using tomorrow's money to finance more things here. You're using your money in a way that's going to build you wealth, because now you're spending some money here, but you're also spending some money here, and you're saving some money for emergencies. If you want to use debt, you can use debt here, but you got to be strategic about it. Like I said in the beginning of this video, debt is a tool, and if you don't know how to use this tool the right way, it can end up biting you in the you know what. This is hard. Not only do you have to make financial sacrifices, because now you might have to sacrifice a new car, you might have to wait to go on a vacation, you might not be buying all the nice clothes, but you also have to deal with the mindset side of things, because all of your friends and family are going to be wondering why you're driving a beat up car and why you're wearing the same clothes you wore on Instagram last week. But if you don't want to live like the majority of people, and you really want to start developing and living this minority mindset, then you gotta stop doing the things that kept you broke in the first place. Now, before we get into the next clip, I do want to let you know that if you are interested in learning more about money management and investing, our team has put together an amazing guide that will walk you through the things you need to know about managing your money and starting to invest your money the right way. That way you can build your wealth. This guide is completely free when you sign up for our daily newsletter. So if you want to download this free guide and start reading our daily newsletter, I got the link to how you can download it for free in the description below. If you really want to understand why the middle class is getting wiped out and why poor people and the people who are not financially educated are going to continue to become poorer, we got to take a step back and really understand what causes poorness and poverty to begin with. Now, I know that's a super deep question, and we have systemic issues, and we have political issues, and we have geographic issues. But if we just focus in on the financial side of things, I want to read you this tweet by a professor from the OSU Entrepreneurship School who says, "What causes poverty? Nothing. It is the original state, the default and starting point. The real question is, what causes prosperity?" That's an interesting take on things, and it's essentially saying that we're all born flat, zero, with nothing. We're all born poor. But how come some people become wealthy while other people don't? Nobody is born a millionaire, as in creating millions of dollars of value. Sure, maybe you have rich parents who give you a trust fund, and as soon as you're born, you're worth millions of dollars because your parents are rich. But nobody comes out of the womb producing millions of dollars worth of value. So if you jump a little bit deeper into that question of what creates wealth, there are 5 things that create wealth. I'm gonna go over these 5 things, but before I do that, I need you to do me a quick favor and smash the thumbs up button below. If we stick with the assumption that everybody is born flat with nothing, how do you become wealthy? Well, the first way someone can become wealthy is if you win the genetic lottery, meaning you have rich parents, and so yeah, you're born with nothing, but then mom and dad can transfer $1 million into your account, and boom, you're a millionaire even though you haven't created any value. So, this is a portion of people. It's not everybody, but some people do become wealthy just because they were born into a rich family. There's no control over which family you're born into. You can't decide who your parents are. We don't get to decide what our parents did or what our grandparents did. But this is just the reality. Some people win the genetic lottery, and because of that, they're wealthy. The second thing is just luck. Some people win the lottery. Some people go to the gas station, they pay $2 for a Powerball ticket, and they win $24 million. Some people are lucky in that sense, and they become wealthy because of it. And there's a lot of different kind of layers of luck, because even beyond just winning the lottery, if you live in a first world country and you can speak and understand what I'm saying, and you have access to the internet, you have access to running water, you have access to shelter, you don't got to worry about bombs flying over your head, that's also another form of luck. And so there's a whole bunch of different layers of luck, but people can become wealthy just because of luck if you go out and you go to the casino, or if you go out and win the lottery, and these things could put millions of dollars in your lap. Now again, is that likely? No, but it is possible, and some people become wealthy because of luck. Third is hard work. This one works most effectively when you couple it with number 5, financial education, but some people are going to work 2 or 3 jobs and they're gonna bust their butt, and they're not gonna spend any money, and they're gonna work really hard to make as much money as possible. That way they can become wealthy, and they're gonna take all of the extra money that they have and invest it. That's why some people can work minimum wage jobs and retire very wealthy, while other people retire broke, because some people are willing to put in a crazy sacrifice for decades in their lives while they are living off of very little, and they're investing every penny that they can because they want to become wealthy, and they're busting their butt, not getting any sleep, working very hard to become wealthy. Now again, if you have the right financial education, it becomes much easier, but some people do become wealthy just because of the efforts that they put in. It is very hard to become wealthy just because of your labor and your efforts, but some people do that. The fourth way, and probably the most common way that people become wealthy, is again a combination of 4 and 5, but it goes into education. I'm speaking more of kind of like your traditional education, where now you go and become a doctor, you go and become an attorney, an accountant, you earn this really high salary, and if you have the right financial education, then now you're going to use this high salary as a tool where now you have a lot of money that you can invest and save. That way you can become wealthy, and that's why a lot of people say that education is the route out of poverty. But if you don't have education with financial education, then education can just put you into a deep spiral of debt, because now you go out and become a doctor and you have $200,000 worth of student loans. And as soon as you start making this doctor salary, if you start enjoying this doctor lifestyle with the nice cars and the nice vacations and the nice clothing, then you could be broke for the rest of your life. So again, this is why number 5 is really important with number 4, just like it's important with number 3. And if you want to keep your money here and here, you got to have financial education as well. but you can become wealthy if you have good education, because that can help you make a better salary. And if you have a better salary and you know how to do with your money, then you can become wealthy. You don't need a doctor's salary to become wealthy. If you're working hard at your job and you have financial education, you can become wealthy. You just got to understand number 5, which is the 5th way that you can become wealthy, which is really a part of 3 and 4, but it's using your money as a tool instead of just spending all of the money you get. Because the whole idea of financial education is understanding how to use your money instead of just making money and then wondering where all your money went. Because at the end of the day, it doesn't matter how much money you make. It doesn't matter if you're born a millionaire. It doesn't matter if you win $1 million. It doesn't matter if you make a lot of money because you work a lot of jobs. And it doesn't matter if you're a doctor. If you don't have the right financial education, it doesn't matter. You're not going to be able to keep your wealth because you don't know what to do with the money you make. So at the core, it doesn't really matter how much money you make. If you have financial education, you can become wealthy. If you don't have financial education, you never have a shot at becoming, or I guess keeping your wealth, because you can win the genetic lottery and you can win the lottery without producing a lot of value to make money, but you're not going to keep that money unless you got the financial education. Now, if we go back to the original assumption that everybody's born as 0 and starts as 0, that doesn't mean that everybody has to put in the same amount of effort or has the same effort required to get to wealth, because everyone's going to have a different path. People are going to have access to different resources. People are going to have access to different connections. People are going to have different parents. People are going to have access to different things, which makes the path to wealth a little bit easier. I guess this kind of goes into the luck part over here. Like for my grandparents, becoming wealthy was irrelevant because for them, their goal was just to be able to survive because they were refugees. When our home state of Punjab, which is in India, was severed during the Indian partition, they had to literally run for their lives. And so my grandfather had a sword, and that's what he used to protect himself during this migration. And he saw his own family members get killed right in front of him. So for him, there was no inclination or really stress or work to become wealthy. It was just being able to survive because he lost everything. He lost his family, he lost his home, he lost his land, and so he had to start all over again. And so for them, it wasn't this path to wealth, it was this path to survival. When my parents immigrated to America, they didn't know the language, they didn't know the culture, they didn't know the people, and my dad said he had less than $100 when he came to America, but he had to make it work. And so now you're working off of hard work and education just so you can survive. So assuming that everyone starts at 0, these are the things that can build your wealth. You can be born with rich parents, you can be born lucky, maybe you're born in a first world country, you can speak English, you have access to technology, that's lucky. Even if you don't win the lottery, it's lucky if you live in a first world country and you have access to running water and you don't got to worry about bombs flying over your head, that's lucky. Now your path to wealth is a little bit easier than somebody who's living in a third world country that can't speak English, that doesn't have access to the internet, that's worried about a bomb flying over their head. So you got a little bit of element of luck there too. Your hard work, your education, your financial education. These are the things that can help you become wealthy, and the things that kind of destroy wealth are now especially lack of financial education. This is one of the most prominent things that you see happen in first world countries, because now you have so much money and you have so much access to credit and everybody has all these nice things. So what do? Well, you use tomorrow's income to finance today's lifestyle with debt. And now you're living paycheck to paycheck because you're financing everything. You have a brand new car that you financed. You have new AirPods. You have Lululemon leggings. You have $20,000 worth of credit card debt. You have $60,000 worth of student loans just because you think this is normal, because everybody else keeps spending money and has all these nice things. So you think you should do it too, and you don't understand the real cost of this, and you don't understand how you can use your money the right way. Now, of course, even in first world countries, there are other things that can destroy your opportunity to become wealthy, like having a poor mindset. If you don't have a good mindset, you have just destroyed all chance that you had to become wealthy unless you win here or here. But if you don't have a good mindset, I mean, that is the foundation to becoming wealthy. That's why we are the minority mindset, because it's about the mindset of thinking differently than the majority of people, which is why if you haven't subscribed to our YouTube channel yet, you should do that. But the reason why this is so important to understand now than ever before is because we're in a society where the rich and the financially educated are becoming richer, while the middle class is getting wiped out and the poor is becoming poorer thanks to two things. The first is cheap debt. And when I say cheap debt, I mean first that it is very cheap for you to go out and borrow money. So if you want to go out and buy a home, or if you want to go out and put more money on your credit card, it is very cheap to do that. And the second part of cheap debt is that it is very easy for you to go out and qualify for more debt. This cheap and easy access to debt makes a lack of financial education so much more painful now, because we're seeing a whole new generation of people that are just racking up debt, using this debt, this cheap debt, to buy things that are not paying them, because it is now so easy to go into debt. Back in the day, the worst kind of debt was credit card debt, because with credit card debt, you would have to go to the store and you could swipe your card and you didn't realize how much money you were spending. So if you were bad with your money and you didn't know how to spend your money, having a credit card was kind of like adding fuel to the fire, because now anytime you shopped, now you were more likely to spend more money than you had. Now we're seeing this problem become a whole lot worse because you can just shop online. And so instead of having to drive to the store to spend money off your credit card, you have one click, push to buy, and so you can rack up this credit card debt without even realizing it, and it is so much more easy to go into credit card debt. But even worse than that, we have a whole new kind of online programs to help people buy now and pay later, or as I like to call it, broke now, broke later, because you have all these programs like Affirm and Afterpay, which allow you to shop online at your favorite e-commerce stores. And when you go to the checkout page, they say, hey, instead of paying this $100 right now, do you want to pay it off in installments? And so we have this kind of whole new generation of people that are entering this whole new world of buy now, pay later, because we have never really experienced the real cost and effects of this yet. Like with credit cards, we know that credit cards is expensive. We know that credit cards can be dangerous if we don't know how to use them, but if you know how to use credit cards, they can be a great tool. Now with these buy now and pay later programs, it is very easy for people to get access to money that's not theirs, to buy things that they don't need, and to buy things that are not paying them. And beyond just that, because interest rates are so low, you have so many people borrowing money or pulling money out of their homes because they're thinking, wow, interest rates are so cheap, so might as well pull some new equity out of my home because home prices have been shooting up. And so people are just pulling cash out of their homes, that way they have more money to spend. Now, refinancing on your mortgage is a great idea, especially when interest rates fall, because now you can save a whole lot of money in your mortgage just by getting a new cheaper mortgage. But when you're pulling out equity in your home, this is kind of like imaginary money, because the real value of your home is not what an appraiser thinks your home is worth. It's what someone's actually willing to pay for your home. And so now you have a whole kind of industry of people that are pulling out cash out of their homes because interest rates are so low, and they're using this cash to go out and shop. Mortgage debt might not be as expensive as credit card debt, but now we have all these people that are going into debt because debt is so cheap, and they're using this money to shop, and at the same time, it is easy to access this debt. So we have so many people borrowing money to buy things that are not paying them. Wealthy people and the financially educated don't do that. They're not going into debt to finance their vacation to Cancun. They're using debt, if at all, they're using debt to buy assets which make them money, because now you're using the bank's money, which is cheap, and you're using this bank's money to make you more money. The majority of people, when they're going into debt, they're using this money to buy things that make them look rich. Vacations, clothes, cars. These things make you look rich, but they keep you broke. Wealthy people and rich people, if they use debt, they're using it as a tool to buy assets which are cash flowing, which are making them money, while the majority of people are not. And so you have this whole kind of group of people, this majority of people that are going deeper and deeper into debt to buy things that are making them broker, while the financially educated are using this cheap debt to make them richer. And so this is the first thing why you're seeing this bigger divide between the rich and the poor, because there's such easy access to debt. And so rich people are using this easy access to debt to become richer, and the poor and the financially educated are using this easy access to debt to buy things that are making them poorer. The second reason why you're seeing a bigger divide between the rich and the poor is because of inflation. After the 2008 crash happened, you saw so much money printing happen in 2008 and 2009, and when this money printing happened, that devalues our dollar. And then when the 2020 pandemic and recession hit, you saw even more money printed in 2020 and 2021, which caused even more devaluation of the dollar. Every time you print more money, the value of the dollars that you're working hard to earn and the value of the dollars that you're working hard to save goes down, because our dollars kind of run like supply and demand. When you have more dollars in the world, the value of each dollar that you have doesn't have as much buying power. And so as more and more money is printed, the value of each dollar that you hold goes down. So the whole idea behind inflation is that as more money is printed, the value of your dollars go down, which makes the price of everything else, your rent, your groceries, your vacations, your hospital bills, go up. And it's kind of funny and sad at the same time, because the Federal Reserve Bank comes out and they say that inflation is not that bad, and so they're working to increase inflation, while at the same time we have a whole generation of people that can't even afford their housing payments. Sure, maybe on your projections and your inflation charts, inflation might not look so bad, but if you look at reality, not just in theory, but reality, the real life that people are living, people cannot afford their cost of living because housing prices keep going up and your groceries keep going up while wages don't keep up. And so we have a whole generation of people that are really struggling to survive financially because we have the cost of living going up, we have the standard of living going up with wages that are not going up, and we don't have any financial education because none of us go to school learning about how to manage our money. None of us go to school learning about how to invest or how to build our wealth. But if we did, then a lot of people probably would be using their money very differently. Because if people understood about how money worked, if people understood about how inflation worked, if people understood about how debt worked, then chances are you wouldn't see so many people racking up credit card debt to have the newest shoes, to have the newest clothes, and you'd have more people putting money aside to invest. Because when you invest your money in assets, like a rich people and financially educated people are doing, now your money is growing with or faster than inflation. That way you can become wealthier as inflation happens, because the Federal Reserve Bank has made it very clear that they are actively working to increase inflation. As they increase inflation, who pays the price? The poor and the middle class. Well, the middle class is getting wiped out, but the poor are the people that pay the price because now your rent goes even higher, your groceries go even higher, your vacation costs go even higher, and your wages may or may not keep up. And so the poor are paying the price because it's kind of like a hidden tax. The cost of everything goes up, but you don't have enough dollars to pay for everything, while the financially educated are benefiting because now if you own the assets, the price of your assets and your investments are going up with or faster than inflation. And so this is where financial education becomes so important, because if you understand this, you can use your money as a tool to make you wealthier. If you don't understand this, well, now you're just a pawn in the game that's making everybody else rich. Cheap and easy access to debt with rising inflation is not a good combination for the majority of people because we lack this financial education in our society. It is becoming so important because these things are going to continue to get worse, and every time you see the government come in and print more money, you see more inflation happen, and every time you see this easy access to debt, you're going to see more people go deeper into debt. And so we're creating this really bad kind of vicious financial cycle where the only people that are going to be able to break out of the cycle are the people that really understand money. Because if you don't understand how money works, you're going to continue spinning your wheels and you're going to continue wondering, why is it that you can't get off of this hamster wheel? You just keep spinning your wheels faster and faster and faster, and you're not getting anywhere financially. The only way out of this mess is really financial education, because now you can understand how to use your money the right way, you can understand how to invest your money, and you can understand how to grow your money. If you enjoyed this video, here's a video on investing that I think you'll love, and while you're at it, download our free money management and investing PDF, and as always, keep hustling. So if you really want to become wealthy, you got to understand that. And you got to stop hating people for becoming wealthy and understand the game and win at the game. Now, if you don't like the system, then what you should do is become wealthy and then use your wealth to give back and help other people.